Exercise 4.2. John Jonas is the owner of Jonas Tires, a business that manufactures tires. The financial year ends on 30 June every year. Required. Do the following for the year ending 30 June 2025. 4.2.1, we've got to calculate the direct labor cost from the information contained in information 3. 4.2.2, we have to prepare the correct note for factory overheads by referring to information 4. And 4.2.3, we have to prepare the production cost statement for the year ending 30 June 2025. Information 1, the following balances are available at the beginning and at the end of the financial year for raw material inventories, work in progress inventory, indirect material inventory. 2, during the year, raw materials amounted to 460,000 rand and was purchased to be used in the production process. Stock with a value of 17,300 was returned to suppliers. Number 3, there are 6 employees in the production section of the factory. During the year, every one of them worked 1,850 hours normal time at 75 Rand per hour. 2 employees also worked 240 hours overtime at 80% more than the normal rate per hour. In information number 4, the following figures relating to factory overheads are revealed for sundry factory expenses, indirect materials, rental expense, advertisements, insurance. The salary of the factory foreman needs to be calculated, and water and electricity. The following mistakes relating to factory overheads were noted. 4.1, the opening balance of indirect material stock was not considered to calculate the indirect materials that were consumed during the year. All indirect materials is only used in the factory. 4.2, the amount for rental expense is the total amount that was paid during the year. However, rentals should be apportioned between the factory, sales, and administrative divisions in the ratio 6:2:1. 4.3, the amount for insurance is the total amount that was paid during the year. It includes the premium for July 2025. Only 60% of insurance relates to the factory. 4.4, during June 2025, the factory foreman was paid on paid leave. His salary for June 2025 has not yet been recorded. The factory foreman received a monthly increase of 500 Rand per month on his previous monthly salary of 8,000 Rand as from 1 January 2025. 4.5, only 40% of the water and electricity costs has been apportioned to the factory. It should have been 60%. 4.2.1, calculate the direct labor cost from the information obtained in information 3. So there are 6 employees in the production section of the factory. During the year, every one of them worked 1,850 hours normal time at 75 Rand per hour, and 2 employees worked 240 hours overtime at 80% more. So the overtime rate will then be 75 Rand times 1.8, which is 135 Rand an hour. So to calculate the direct labor cost, it was 6 workers at 75 Rand per hour for 1,850 hours to give you 832,500 Rand. Then 2 workers worked 240 hours overtime at the new rate of 135 Rand, and that gives you 64,800 Rand. So our total direct labor costs will then be 897,300 Rand. 4.2.2, prepare the correct notes for factory overheads by referring to information 4. So obviously we're going to first write down everything that needs to go into our factory overheads notes. And if we go back to the question, it will be sundry factory expenses, indirect material costs, rental expense, insurance, salary of factory foreman, and your water and electricity. The sundry factory expenses was given as 98,360 Rand. Our indirect material costs, if we go back, they said the opening balance of the indirect material stock was not considered. So our opening balance for our indirect material costs according to information 1 is 13,000 Rand. So that needs to be added to the 57,000 to give you 70,000 Rand. Rental income. The amount for rental expenses is the total amount that was paid during the year. However, rentals should be apportioned between the factory, sales and admin in the ratio 6:2:1. So we need to allocate the correct ratio. So the rental expense will then be 6 out of 9. How I got the 9 is you add 6 plus 2 plus 1 together. So rental expense will be 6 parts out of 9 parts. So 225,000 times 6 divided by 9 gives you then 150,000 that goes to the rental expense. For insurance, the amount for insurance is the total amount that was paid during the year. It includes the premium for July 2025, and only 60% of the insurance relates to the factory. So obviously the prepaid expense for July should not be considered. So if we go to insurance, the 80,600 for insurance, the 1 month needs to be taken away, and it's only 60% that goes to the factory overheads. And if we do the calculation, we get an amount of 44,640. Salary of the factory foreman. During June 2025, the factory foreman was on paid leave. His salary for June 2025 has not yet been recorded. The factory foreman received a monthly increase of 500 Rand per month on his previous monthly salary of 8,000 Rand. And from 1 January 2025, the increase occurred. So let's work out how many months. It's the whole of January, February, March, April, May, June. So for 6 months, it is the increased amount, and for 6 months, it will be the normal amount. So 6 months, it will be for 8,000 Rand, and then it increased by 500 Rand. So then for 6 months, it will be 8,500 Rand. And if we do the calculation, we then get the salary of the factory foreman as 99,000 Rand. Water and electricity. 40% of the water and electricity cost has been apportioned to the factory, but it should have been 60%. So out of the 32,000 Rand, we first have to work back to take away the 40% and then get the correct figure to times it by 60%. And if we do that, we then get an answer of 48,000 Rand that should have gone to water and electricity in terms of the factory overhead expenditure. Then our total factory overheads, if we add up all these amounts, will then be 510,000 Rand. (4.2.3) Prepare the production cost statement for the year ending 30 June 2021. So firstly, we need to complete the format. We are going to start with our direct material cost, then our direct labor. Those two costs added together gives you your primary cost. Then we're going to have our factory overhead cost. If that gets added to your primary cost, it gives our production cost during the year. Then we're going to have our work in progress inventory at the beginning of the year to give us our total production costs, and then we will subtract our work in progress inventory at the end of the year to give us our cost of production of finished goods. So this is a format that you need to study for your exam or test. For the direct material costs, we're going to have to do a calculation. We'll take our opening stock plus our purchases minus our returns minus our closing stock. So if you go back to information 1, 2, 3, 4, okay, our opening balance for direct material costs is, if we go and read it, is 180,000. So we're going to start with 180,000. Then we purchased, according to information number 2, 460,000 Rand. We returned 17,300 Rand. And then according to information 1, our closing balance at the end of the year is 20,000. So if we do this calculation, 180,000 plus 460,000 minus 17,300 and minus our 20,000 closing balance, we get an answer of 602,700 Rand. Our direct labor cost we calculated in 4.2.1 as 897,300 Rand. So our primary cost will be those two costs added together, and that will give you 1.5 million Rand. Our factory overheads we calculated in 4.2.2 as 510,000 Rand. So our production cost during the year, if we add those two amounts together, it's 2,010,000 Rand. Our work in progress inventory at the beginning of the year, if we go back to information 1, is 90,000, which we add. So our total production cost will then be 2.1 million. Our work in progress inventory at the end of the year, according to information 1, is 60,000 Rand. That we will subtract. So our cost of production of finished goods will then be 2,040,000 Rand. Exercise 4.3. Tony's factory shop is owned by Tony. Required. 4.3.1, we need to calculate the break-even point. 4.3.2, should Tony be satisfied with the break-even point, explain and provide figures. And 4.3.3, refer to the production cost per unit, identify one production cost item that has improved, provide one reason for the improvement. So the information they give us: the total units produced and sold, the break-even point for 2024, sales price per unit for 2025 and 2024, our total variable costs, our variable cost per unit, our total fixed costs, and our fixed cost per unit. (4.3.1), we need to calculate the break-even point. So remember, our formula for the break-even point is our fixed cost divided by the selling price per unit minus the variable cost per unit. So it's going to be 306,000 divided by 135 Rand minus 85 Rand to give you 50 Rand per unit. So 306,000 divided by 50 Rand gives you 6,120 units. Should Tony be satisfied with the break-even point, explain and provide figures. So no, he's definitely not satisfied, because the number of units produced of 6,000 is less than the break-even point of 6,120. So he's not producing enough units to cover his costs. 4.3.3. Refer to the production cost per unit. Identify one production cost item that is improved. Provide one reason for your improvement. Okay, so let's see which production cost item improved. So if we go back, the direct labor cost has definitely improved. It improved from 47 Rand 50 to 42 Rand 50 per unit. Reasons can be workers are better trained, less overtime fees, better control over working hours, or workers are more productive. Exercise 4.4. The information relates to Andy manufacturers. A profit margin of 50% on cost price is maintained throughout the year. Required 4.4.1. Prepare the Statement of Comprehensive Income for the year ending 28 February 2025. Information. The following figures are available for the year ending 28 February 2025. Our finished goods inventory at the beginning of the year, revenue, debtors allowances, administrative costs, sales and distribution, and finished goods inventory at the end of the year. Take note, included in the revenue of 960,000 Rand is sales of 60,000 Rand on which trade discount of 20% was allowed. A profit margin of 50% on cost price is maintained throughout the year. The finished goods manufactured during the year must be calculated as a balancing figure. 4.4.1. Prepare the Statement of Comprehensive Income for the year ending 28 February 2025. So we start with our revenue. Remember, the revenue is always your net revenue. So we're going to minus our debtors allowances. So 960,000 Rand, which is our revenue, minus our debtors allowances of 30,000 gives us 930,000 Rand. Cost of sales, if we go back to the information, they say included in the revenue of 960,000 is sales of 60,000 on which trade discount of 20% was allowed. So we must work backward to get the amount before the trade discount. So we're going to take 60,000 times 100 divided by 80. And then they also say that a profit margin of 50% on cost price is maintained. So to calculate the correct sales amount after the trade discount of 20%, it's going to be 60,000 times 100 divided by 80, like I said previously, and that gives us 75,000 Rand. So in other words, our correct sales amount is 900,000 plus 75,000, which is 975,000. Then we are going to minus our debtors allowances of 30,000, and then our profit margin is 50% on cost. So we'll times 100 divided by 150 to get our cost of sales. And our cost of sales will then be 630,000, which we minus from our net revenue. So our 930,000 minus 630,000, our gross profit will then be 300,000. Our finished goods at the beginning of the year is given as 75,000. Our finished goods manufactured during the year will be our balancing figure. Our finished goods available to be sold will be 630,000 plus 95,000, because our finished goods at the end of the year is 95,000 given. So if we work backwards, our finished goods available to be sold will then be 630,000 plus 95,000 to give us 725,000. And our finished goods manufactured during the year is in our balancing figure of 650,000. So we take the 725,000 and we minus the 75,000 to get 650,000 as a balancing figure. Then after we've calculated the gross profit for the year, we then consider any administrative costs or any sales and distribution costs. The administrative cost is given as 80,000 Rand, which we'll minus, and the sales and distribution cost is given as 30,000, which we will minus. So our net profit for the year is then 300,000 minus 80,000 minus 30,000 to give you 190,000 Rand as your net profit for the year.